Problem 16-35. We're going to do the statement of cash flows, and we're going to calculate free cash flow. So the comparative balance sheet of Jackson Educational Supply at the end of December 2024 reported the following. So we've got a comparative balance sheet, and we've got some transactions. Requirement 1. Prepare the statement of cash flows of Jackson Educational Supply for the year. Use the indirect method. For operating activities, use a minus sign or parentheses. For results are a decrease in cash. And if a box is supposed to be empty, leave it blank. So this should be getting pretty easy. We've done a lot of these statements of cash flows by now. But just as a reminder, in the operating activity section, we're going to start with net income. Then we're going to back out depreciation and back out gains and losses. So our net income can be found over here. 57,600, copy and paste. Depreciation is historically the first thing listed in the operating activity section. We've got 16,700, or we need to back it out, and because it does not lower cash, but it does reduce net income, so we have to back it out by adding it back in since it is an expense and a lowered net income. Next we have our gains and losses, and looking through here I don't see any gains or losses. So after gains and losses, we're going to analyze changes in current assets and then analyze changes in current liabilities. And if you notice the arrows, if a current asset goes down, then cash must have gone up. So the arrows are opposite for current assets, the direction. So let's analyze, well, technically the first current asset is cash, but that's going to go at the bottom of the statement of cash flows. Next is AR. What do we have going on with AR? Looks like AR went down, so we have a decrease in AR. So if AR lower or fell, we must have collected on AR, so cash went up. So we're going to find out the difference between 22,000 and 15,300, and the difference is 6,700. And it's positive because cash went up. So it looks like inventory, another current asset, went up, so cash must have gone down because we must have paid for it. We must have bought it. Minus 2,200. I'm putting a minus in there because cash went down. And why did cash go down? Because inventory went up. Next, we've got our liabilities. Let's start with accrued liabilities. It's easier to understand in this case because this liability went down. Went down from 11,300 to 10,600. So that is $700. And if our debt went down, what means we must have paid for it, therefore cash went down. We have to make that a minus 700. Decrease in accrued liabilities. And then we've got AP going up. And remember, for liabilities, they go the same way. So if the liability goes up, then we have to add that back into cash. And what is that difference? The difference in AP is 2,000. So we're going to add that back in. Increase in AP. And again, the order and the operating activity section does not matter. So that's it for the current assets and current liabilities. So we're going to take 16,700, add 6,700, subtract 2,200, subtract 700, add 2,000, and we get what? I believe that is 22,000, 500. Then we're going to take net income, add it to this since they're both positive numbers, and we get 80,000, 100. So we get positive cash flow, $80,100 from our operating activities. Well done. Next, investing activities. What goes in the investing activities section? It is changes to long-term assets. And if you're visual like me, you can use this. Changes in long-term assets go in the investing cash flows. So what we're going to do is we're going to start up here. And to get this window on top, I'm going to close it and then reopen it, because I like to block out the other things so I don't get distracted. Payment of cash dividends. That is not a long-term asset. Purchase of equipment with cash. Here we go. So since we purchased it with cash, cash is going down, so minus 54,700. And cash, what is it? Acquisition, what did we buy? Equipment. Next we've got issuance of long-term note payable. That goes in the financing section. Common stock, that's financing. Depreciation, we've used it. Here we go. Purchase a building with cash. So since we purchased that building, cash is going down, 98,000. Acquisition of building. Anything else? No other long-term assets. So what we're going to do now is we're going to take 54,700, add it to 9,800, excuse me, 98,000. We get minus 152, comma 700. So we used up a bunch of cash to buy long-term assets, in particular equipment and building. Our last section, financing. Hopefully you remember that is affected by changes in long-term liabilities and owner's equity. So again, we're going to go back up here and look for changes in long-term liabilities or changes in equity. So cash dividends are paid out of retained earnings. Retained earnings is part of equity, so we're going to include this. So 16,200, since we paid cash dividends, cash is going down, therefore it is a negative. Cash payment of dividends. What's next? Equipment, we've already done that. Issued long-term note payable to borrow cash. Cash receipt from issuance of notes payable, 48,000. And cash is going up, so we're going to leave that positive. Issuance of common stock, that's a lot of cash. Cash is going up, 105,000. Cash receipt from issuance of common stock. Why is common stock going in the financing activity section? Because that's equity. And that's it. So we're going to add these three. We'll technically add two of them and subtract 16,200. And we get cash positive 136,800. So we get a lot of cash from financing activities, most of it from issuing common stock. Next, net increase or decrease in cash. We can take this number, subtract this number, add this number, and place it here. You should also double check. Take this current year's cash, subtract the last year's cash, and that difference also goes here. Net increase or decrease in cash is 64,200. So next goes last year's cash, 2023, copy and paste. Next is this year's cash, 87,700, copy and paste. Good job. So the most important section, remember, is operating activities. So are we getting cash or losing cash to operating activities? We are generating cash. Positive 80,100. What's the company doing with plant assets? Looks like we're buying them. Investing in new. Divesting means getting rid of. There's more financing. Let's see. What's financing from issuing stock than by borrowing? So we borrowed 48,000. We got much more, a lot more from common stock. And what happened to cash during the year? Positive 64,200, as you can see from over here. But the easiest place to get it is right from here. So cash increased during the year. So everything looks good so far. For the reasons given above, Jackson's cash flow looks strong. Now we are going to do the calculation for free cash flow. It says if Jackson plans similar activity for the next year, what is its expected free cash flow? Use a minus sign or parentheses for amounts that result in a decrease in cash. Here's some abbreviations used. Cash payments for planned investments. Cash payments for planned, cash PMTS for a planned invest means cash payments for planned investments in long-term assets. NCOA is net cash provided by operating activities, and NCFA is net cash provided by financing activities. So the formula is we're going to start with net cash provided by operating activities, NCOA, and we're going to subtract cash payments for planned investments in long-term assets. And then we also subtract cash dividends. So then we plug in the numbers. So notice it says if they plan similar activity. So we're going to assume, let me close these. We're going to assume we're going to have approximately $80,100 of positive net cash from operating activities. Cash payments for planned investments. We're going to use this. Oops, I grabbed the wrong one. We're going to use this 152,700 because this is where we're investing in plan assets. So I'm going to copy and paste 152,700. And then we're going to assume we're still going to pay the same amount in dividends, which was 16,200. So we're going to take 80,100 minus 152,700 minus 16,200, and we get minus 88,800, minus 88,800. So they're not going to have any free cash flow. So they can't, if they're going to have the same amount of operating activity cash, or cash from operating activities, they're not going to be able to continue to invest at this rate in perpetuity. Something's going to have to change. Probably it will slow down in their investments, but hopefully their net cash from operating activities increases. And that's it.